Absolutely. As with everything that Zynergia does, we've got bifurcated options. So whether it's dental and vision, we've got multiple carriers. Healthcare, we've got multiple carriers. Um, and obviously workers' comp, they've got multiple carriers. So it's good to have choices to try to make sense to what the client needs and not try to just put them into a box. So yeah, we do have other options with national carriers that also have flexible in participation requirements, not flexible contribution requirements, but flexible participation.
Welcome to Insurance Shoptalk. This is the podcast where the world of commercial insurance gets a little closer to home. I'm your host, Eric Stein, and in every episode, we're taking a deep dive into the insurance industry, from the latest news and trends to in-depth interviews with InsurTech experts, carriers, and agency newsmakers. We're covering it all. So sit back, tune in, and let's start the conversation. Well, hey, I want to thank David Bell and David Ainsworth with ZynergiaHR for being on today. How are you guys doing?
Oh, doing well, thanks.
Doing great.
Yeah.
Hope you are.
We have our first guest host that I've done for my podcast, which is Ryan Floyd, who works with Insurance Solutions, an agency that I'm one of the principals of, MGA. Ryan, welcome aboard.
Thank you. Happy to be here.
Nice. So I'm super excited to have the Zynergia on with David and David. We've got David Bell is going to cover a lot about workers' compensation. David Ainsworth is going to cover about benefits programs. Ryan will kind of help me kind of jump in and out of both. But and then to kind of back up for a second, ZynergiaHR has a PEO program, which for those of you who may not be as familiar with PEO, a PEO is a co-employer arrangement whereby allowing a client to gain access to lower negotiated rates on workers' comp and other benefits and payroll services, HR, risk management, everything consolidated into one vendor at a reduced pricing. And the benefit to the client is that they're able to reduce costs, streamline operations, lower risk and liability by joining forces with the PEO. At the same time, they're able to hire, fire, set wages, run their company as if, they always have. But administratively, Zynergia has a very large master policy, as an example, for workers' comp and employee benefits that that has millions of dollars of premium. And in some cases, there's some deductible programs that they're responsible for, not the customer, that lowers the pricing to that client dramatically. So I know some of you in the P&C world have used PEOs many times as a last resort or for a high mod, or maybe the client was already with a PEO. But today's conversation, I think you're going to find the way that Zynergia is structured is so unique in that they just have multiple ways the client can interface with them to gain access to their programs, some with payroll, some without payroll, which I know is a big sticking point sometimes due to the fact there's a late nature in the P&C world with a client binding their coverage because of the carriers getting the quote back late to you, the agent. So, and there's every decision's got to be made in a snap sometimes. So that's where Zynergia comes in and has been a phenomenal partner at Insured Solutions with us to be able to offer them to you. And they write all types of phenomenal types of risk as well. So I just wanted to set the stage. David Bell, I don't want to take too much of your thunder. But so, David, why don't you talk a little bit about your background briefly and how you, designed Zynergia to help, sell and service clients in the blue collar industries.
Yeah, you bet. So I've been in the PEO and large staffing world for 30 years now, primarily helping larger PEOs with their risk management programs. That's kind of my bailiwick. So as a consequence, we have best practices for large PEOs and also, and maybe very importantly, different spin on how we do things. We have partners like Marsh and CBiz that are willing, through those 30 years of relationships, willing to go to bat for us and move some mountains for us. So as far as design, we're taking that knowledge that we've gained from all those years. We have a bifurcated workers' comp program, so not we use SUNS, but we also use key risks, different constructs, different appetites for underwriting. But we do have 2 carriers that we can access. If even going outside of those carriers, we have the Marsh and Lockton perhaps can help us obtain policies that normally you might not be able to get as well. So as far as best practices in risk management, we do a number of things a little bit differently than a carrier. We have all the analytical tools available to us for analyzing presented risks. So we don't necessarily function like a carrier where there's discounting, credits, debits, you have to use the mod, et cetera. I tend to look at the risk itself, its experience, then we run it through our analytics and we come up with a loss pick. So it's experience-based pricing and risk assumption that we do. So, those high mods that present, maybe we use the mod, maybe we don't use the mod. So
I've noticed that in the pricing that you work with us on is that, let's say you even had a client with an exorbitantly bad mod is, even over a 2 or even a 3, sometimes that could be related to something 3 years ago, but that mod follows that, of course.
Absolutely.
So you're not where a carrier has to still apply it. You do not, because of the type of programs you offer on workers' comp. You can actually just look at the loss trend and pick and figure out, okay, what do you need to be profitable in this account based on your discounts and deductible program based on that particular carrier. And then you pass those savings on to the client so they're not just automatically tagged with that 3.0 mod forever.
Yeah, absolutely. Absolutely. It's more about the loss pick and the amount of cash for the near future. So we estimate the anticipated claim load and the cash required to pay for the next 12 months. And, so there's lots of incremental factors that go into the pricing on the risk side. Usually it's beneficial for a client to go through that process with us. And, what allows us to do that is you kind of alluded to is, we have a large risk pool. So we're aggregating a lot of different clients into a pool. So unlike a single smaller policy that has a shock loss, it'll affect your mod, it'll affect the cash that the carrier has to pay because they have to account for the premium, or the premium has to account for the cash for the claim from that one client. So those spikes really impact that cash flow of premium to pay for claims. For me, I have a large pool, so I have a lot of clients, so I have a lot of volume. So when someone has a shock loss, I won't be, I generally won't change pricing, unless they have, multiple shock losses over a period of time. So they're demonstrating a trend. So it's about economies of scale, more or less, and large risk pools and large, as you indicated, large workers' comp premium flow allows me to, absorb, past histories, absorb, losses in the near future for current clients, et cetera. So it's all to the benefit of our clients. And obviously, if you don't manage that program, you can get out of control fairly quickly. But, I've been doing it a long time, and we have individuals and expertise within our company to manage the claims, manage the underwriting, manage the, track the loss control items and work with clients to help them control, et cetera. So we have not only the individuals and expertise to control the claims and make sure that it doesn't disrupt the pool. We also have the visibility analytics, and so we basically react real time to anything that's swaying our risk management program. So we
right. One thing I noticed, David, when I was presenting to like a towing company, the proposal for Zynergia, that had a higher mod, like a 180 or so, was complaining about the fact that his carrier was just paying claims, like on an automated basis. He was very upset about it because he knew some of these were fraudulent, or he had information that could be possibly help the carrier and maybe not have to deny that claim. They were more interested in just getting it off the books and closing the file on that because of the time and legal expense. Whereas when I let them know that they're part of that co-employment relationship, does mean a real true partnership in that you are technically liable and responsible for this policy, and you are on the hook for a deductible program, more so than the customer. And that the client can have a smaller deductible if you choose to add that in for that client, but that you are going to be in concert working with the client because you're both in this, hellhole together, so to speak, of the workers' comp world.
Yeah, absolutely, absolutely. To that point, we have internally, we do use TPAs from the carriers or associated with the carriers. So they have that, group on a national basis out there doing their jobs. However, we kind of manage the adjusters also. So we're high performance expectations from the TPAs. So we are monitoring those claims being administrated by the adjusters. And when we see items like fraud, or maybe there's a way to close a claim a little quicker for a little cheaper, we will call those adjusters and kind of have those conversations. So it is the PEO's mod that usually brings preferential treatment to the whole policy, which then extends to the client at cheaper rates. And then, a little bit unusual, we do have access to, the table rates. So we usually, on our carriers, the two that we work with, it's not just them, it's usually their sister carriers as well. So if we need lower rates in a particular state, sometimes we can have them use a sister carrier company, maybe within Berkeley, or instead of using a UWIC for Sons, we use a Sons table for that state. So we do those things as well, which, to get the best manual rates to start with, or the lowest price possible for our clients. So
Hey, David.
A lot of it changes. Yeah.
David, would it be a fair statement to say that the client, and this has been my experience, due to the PEO model and the flexibility of the master policy and how that operates, would it be a fair statement to say that the client, once they come on board with Zynergia, that they're not going to be punished for their prior history? They're going to be rewarded or adjusted based on their performance with Zynergia, and a lot of that revolves around the flexibility in the billing and underwriting. Can you elaborate on that a little bit?
Yeah, absolutely, that's true. So not only do we assess clients when they enter into a relationship with us, whether that's PAYGO, BSO, PEO, so we assess based on their experience and what's happened to them as far as the workers' comp claims history, et cetera. Maybe they've had shock losses, and maybe they had a series of shock losses, but we price it accordingly. And when they come on board, we're not only, taking a look and doing underwriting and due diligence on the onset, but we continue that constantly for the whole, every week. We're pulling the reports, we're looking at each client, we're highly reactive to claims and management of those claims. Also, there's a frequency issue, severity issue with the client. So it's likely that we'll work with them, try to control those costs if possible, if there is a trend or severity that's happening. If not, then we're still in the background monitoring the situations, and maybe they don't have a lot of claims. So if that's the case, we can fix for our clients. We can help bring to bear some loss control and other resources to control the claims. Or if they're performing very well, then we might have a discussion about safety incentives or program incentives, so discounting perhaps. That's a customer by customer, client by client sort of arrangement. It has to do with volume, size, the kind of risk that they're presenting. We definitely want our clients to participate in our risk management program. I think Eric mentioned Sometimes we assign smaller deductibles for recognition of claims that are happening, or offset of some of the cash offset of some of those claims. But that's the negative part of it. But the positive part would be the safety program or safety incentive program, which we do make arrangements with clients when requested, or depends on circumstance and pricing as well. So, but so we're a partner basically. So we will collaborate with clients in a lot of different ways and structure programs in a lot of different ways, and all of which is well managed and highly visible through our reporting.
Yeah,
and go ahead, Eric?
No, you go ahead, Ryan.
I was just kind of going back to the prior statement. You guys have some unique billing methods, and that's what kind of sets you guys apart from many of our other carriers, including standard markets that offer a pay-go plan, which is really not a pay-go plan. It mimics a pay-go plan, but with Zynergia, you guys offer a true pay-go plan because the client is only being billed for what they're reporting to you, whether it be a PEO, full PEO program, or the pay-go module. So can you guys elaborate a little bit on the flexibility of those billing methods and how that kind of adapts to the individual client?
You bet. So, we do operate on a 12-month period, for calculations and analytics, but on the other hand, we're not a carrier, so we're not issuing policies. Although, they are coming through carriers and they are issued for 12-month periods. In my mind, when we're doing the risk management program, I'm assuming that the client's going to stay for a longer period of time. And as far as deposits, we don't have those. The taxes and surcharges are not upfront at the onset of the policy. If we incur those, they're already calculated and built in. So that's a big difference in a carrier pay-go versus us. So our rate is our rate, and that's what we'll apply and charge until something dramatic happens with the account. So, and you really is pay as you go as indicated. So your payroll frequency is weekly or biweekly, whatever it is, that runs through a system. We pull the actual codes and wages, utilized in that time period, calculate the premiums as agreed upon for the billing for the workers' comp codes, and then bill. So it really is pay as you go. There is no estimates, there's no upfronts, and there's no deposits, and the taxes, surcharges are contemplated in the net rate or the bill rate that we're applying. So it really is pay as you go. Gaps in periods of time where there's no payroll, that's another big difference between a carrier. Those can cause a lot of red flags and maybe cancellations. If you run into that situation with us, we do want to understand why that's happening, and then we are able to smooth a little bit, but not indefinitely. So for those construction companies that have low seasons and so on, it's best just to talk to us about the upcoming anticipated situations, and then we generally can work through those as well, keeping coverage in place for periods of time. Because unlike single smaller policies, we're function more like a large broker, where we're submitting large amounts to a carrier, and the absence or infrequency of a few of our clients isn't going to raise a lot of red flags. Basically, they'll call us and ask for the question what where's the payroll, but on the other hand, they're not going to take any corrective actions of any sort. We just have to have a plausible explanation, therefore the conversation with our clients. So
right. Well, we definitely want the clients to be on the same page as you guys, when that relationship begins and as it progresses, because when we approach our clients for your program, we always stress the benefit of the pay-as-you-go type program, because a lot of our accounts are higher risk. A lot of them could be transportation or construction contracting type risk, which are really perfect for that pay-as-you-go program. And so that's really something that we really, it's a selling point for us, and a great thing for our clients, because the cash flow is extremely important for them.
Oh,
So
yeah, we understand that quite well. And just as in the onset, I described a little bit of my history, but I was with one of the largest PEOs, the largest PEO with trucking, and then had huge exposure to security, armed guards, construction, you name it. So, as far as ability to understand, underwrite, and then also manage those clients, I think we probably are a little different than most PEOs, because we have that experience in our background. So we understand them quite well.
Yeah, I like that experience you have in the pricing and rating, David, because Ryan and I have been around a while in the industry. We've seen how sometimes a PEO will just sort of discount a rate and and throw out a number, and that's not a survivable strategy, unfortunately, even though sometimes I love the pricing we're getting.
Yeah.
But for longevity, that's not the way to go. I think working at it like you do as a carrier, like similar to how a carrier would do a rating, on a client based on their losses, is great. Absence of mod, and you just figure that in based on,
Yeah.
their history. To me, that gives you longevity, and also we want you to be profitable for the future, because we know you have to come up with the collateral calls that are due when you're in this kind of program, whether it's a deductible, whether they're losses or not. You have to fund for growth for premium, because you guys do a great job on the loss side, keeping that ratio down. So we want you as a as a sales partner with our agents working with us to do well also there.
Yeah.
Eric, you mean that some groups throw out the honeymoon rate?
What's that?
I was asking Eric, I was like, you mean some groups throw out the honeymoon rate?
Oh yeah, no. So we're I mean, just to get just slightly granular. So we calculate like admin cost of profit of the carrier, so we break it out, the rate into the loss rate component, the cash required component. So there's about 10 sections that go into developing a rate. So we calculate all of those based on a particular client and their presentation. So, the rate that we, tender on our quotes are, contemplates cash needed, let's say for the next 12 months to pay for the anticipated claim costs for that particular client. So we're always pricing everything, all components. So we do it very precisely. And then we make adjustments over, our own loss development factors, our own performance, and apply those back on aggregate to all our clients from that risk pool as well. So we do make adjustments to our pricing very frequently, monthly almost, to make sure that we're performing correctly, et cetera. So very, I think, unusual. There's not a lot of PEOs that do that component of it. I know because I've re-engineered PEOs generally. So I go in and build these things for PEOs. So here we're just taking those all that knowledge and best practices and applying it going forward with Zynergia.
Hey, David, is there anything, knowing that the way the y'all's billing works and the really just longevity as far as a client is concerned, is there anything that you guys do that is a specific strategy to foster a long-term relationship with your client outside of just being involved with their payroll, whether it be a pay-go or a full PEO, you're hands-on there. So that I know that's part of it. Is there anything else that you guys do to kind of create that long-term relationship with the client?
Yeah, absolutely. There's a different fronts. One is we're still doing and choose to do the old white glove sort of service model where we're highly involved to the extent the client wants us to be, but very responsive, and we will offer a lot of different services as good partners. Then, we do have the management and economies of scales that drive the interest in coming on board with us through the quotation process. However, we control if there's reductions, we pass those along. As far as other kind of sticky items, they call it, the healthcare, the 401k, other attributes that we can offer the clients, discount programs, et cetera. So all of those are available to our clients as well. So we try to be good partners, unlike others that are focusing on high volume, low price, low touch. We're the other way around. We offer accurate pricing. We're high touch. And we, try to contemplate and obtain a high retention of our current clients. Just practically speaking, if you're not doing a good job and you have low retention of 60% or 70%, well, you have to replace the 30% that you lost and then try to grow by selling. We don't do that. We have like 95% retention, et cetera, and keep our clients and grow at the same time. So we're very, very interested, a little bit different way. The other thing is a little different with us is unlike others, we're not, we're not a venture capital situation. There's no 3-5 year horizon. So we're here and we're going to be here, and there's nothing in the future that's going to drive, how fast we grow or which direction we grow, or, so, we're controlling our own destiny and choosing to grow at the rate we need to, pace we want to, and taking the risks that we'd like, with the forever horizon. So there's no exit plan for us. So that's a difference as well from other PEOs. There's an awful lot of them do have the start and stop program for sale, basically. So anyways, we're going to be around for a long time.
Nice.
So
And hey, David, one thing that a lot of agents want to know, kind of the differences between the PEO co-employment model and insurance work comp versus how it would be if a client's a named insured. So a couple things I noticed. One, that you will track the mod. I mean, you have the information to supply for the mod tracking for the client, because the agent wants to make sure the mod's there. Secondly, you are very geared to work with the agent community by the fact that you're going to use the normal anniversary date of the client to potentially look at their pricing for a renewal. However, which is good. That's a similar model. So mod tracking, being able to get loss runs, normal anniversary date, and then also that on renewals, the good difference here is that the agent is just so used to having to shop the account every single year. Now with you, I've noticed an agent will just contact a client and go, hey, are you happy with this, the Zynergia and the workers' comp arrangement and other services? Yes. Then the agent does not have to do anything to market the account. And usually, if they're doing a good job, like you said, you're going to look at the pricing and potentially just give them an auto renewal that might be lower, keep them the same. Your whole goal, though, is to stop the spikes like traditional insurance gives based on a mod issue or maybe a claim issue. Your goal is to absorb that when, like you said, the shock loss when you can. Again, giving that client and agent some consistency so that agent can just move on to work on another account. Client can just run their business. I mean, anything you want to add to those statements?
No, that's great. That's a great summary. That's exactly what we do. We don't hold the loss runs. We calculate, the carrier calculates, March can calculate the EMR, so no issues there. And as far as flexibility, I mean, we do have a 12-month, agreement. However, like you were indicating, there's different renewal time periods. There's different period. We can start and stop and go as we need to, if the client runs into a situation. So we're very flexible, so we're not trying to contain and box in clients. I prefer to work with them. Even if the client does part way with us for some reason, maybe they're bought or sold or whatever their company happens to their company, we try to transition, as best we can and offer all information and so on. So, so this is the way we do business. So we don't really change. So we're very cooperative and try to facilitate on behalf of agents, but also on clients. Make sure that they're getting everything that they've requested. and also not to inhibit them as best as we can, as far as if they're trying to administrate to a policy period or whatever it might be. So
Perfect. And one other thing too, I've noticed when I work with you guys, the way that the agents that are really doing well with your type of program would be, first, the cool thing is that you are willing, based on the accord and submission with the loss information, mods, supplementals, you're able to go ahead and give us a price indication that's pretty much going to be the price, unless something else changes. And then we're able to go over that with the agent privately without the client. If the agent says, hey, that's looking pretty good, but as we talked earlier, the carriers are just still pouring in quotes, the 11th hour. So what I suggest to the agent, and some of them most of them will take me up on it, luckily, what I like to do is get your team on with the client quickly to maybe a 20-minute meeting to go over the PEO model in a minute, and then also talk about payroll, because the conversation is going to go terrible if that agent, like we said, waits to that 11th hour to tell the client, hey, great news, I got this phenomenal program, but you're gonna have to switch payroll systems, and you got to do it tomorrow. So that just kills everything, right? So at least get them time a few weeks in advance to understand, to have a 20-minute meeting, understand what it is, and then continue to wait for quotes if they like, but at least the client's in the know and can kind of in their mind be ready. And then luckily, after buying date, you guys are flexible to help that client transition. It doesn't necessarily have to be on a dime like we talked about. You'll help them get bound and then work with them to get that payroll set with a spreadsheet or whatever is needed, so we can just get the ball rolling. But point being, the earlier the agent, if the number looks okay, the earlier the agent can just bring that client in the loop and let them speak to your team just for a minute, and not to have a sales pitch, but just informational, and get to know, let them ask a bunch of the payroll questions to make sure, because sometimes based on the need of the payroll, maybe it's not going to be a fit, because if it's integrated with, billing, general liability, their GL and general ledger and things like that, maybe it's not going to work for that client, or there'll be another time frame that needs to be done with next renewal, that we need to do it in 30, 60 days in advance. But most of the time, payroll is payroll. It's just the client needs to absorb it. Would you say that's true?
Yeah. And we do have a different models, PEO, PAYGO, BSO type models. Some of those are we're doing the payroll, and some of those are they're doing their own payroll and issuing checks, and maybe they're complicated. Maybe it's like some Amazon or something else that use ADP, forced to use an ADP system. So all these things can be integrated. So those conversations are good to be had early. For us, we have lots of different flexibility, lots of different business models, even but at the end of the day, we do need to have information flowing through our system, could be exported and imported into our system. We don't necessarily have to do the payroll, but we do have to, we're obligated to report to carriers, health carriers, workers' comp carriers, and if they want us to do the HR services, we have to have hours. And so, so there is a system component, but as you were saying, depending upon the whether we're doing the payroll or not, we would need it in the system and then functioning, or, if it's a PAYGO sort of model, then we do need it in the system, but it could be done after the fact, the first payroll or second payroll, et cetera. So we have a lot of flexibility, and just depends on what the client would like to have happen. Then we, introduce that particular model that's the best fit. But most of the time we're able to, our internal staff is able to, do the IT or transition, or we can go into systems and pull the information, powers of attorney, if that's required. There's always lots of things we can do. So we never assume a box and then have the client to fit our box. We have the discussion and see what the best program is for that particular client. And we have all these resources and ways to do things. So then we custom fit for that client what they'd like to have happen at that frequency. So it's usually a good conversation to have. and it usually works out quite well for the client.
Right, right. And if again, we can have the time to get that payroll discussion and the client's okay with it. I know agents hate to have this extra conversation about payroll. They just want to kind of get the insurance coverage placed. I totally get it. I'm in the same feeling. But the good news, if the client says yes, is the retention, like we talked about, goes from that 40, 50, 60% with this carrier or program up to about 90 to 95, because it is such a hassle to change payroll. So for the very reason the client doesn't want to do it in the beginning is an actual benefit to all of us and the agent at renewal time, because they're going to stick around because it's just a pain in the neck. And then by the time your team gets a hold of them and starts layering in risk, claims, service, benefits, whatever the client needs, HR, then boom, that's a good golden handcuff to kind of keep them in the program, auto renewing, and agents happy, clients happy, everybody wins,
Yeah, and then as for clients that are not, within one state or one city, et cetera, if they have larger clients or ones that have, growth in states that they, didn't function in previously, we're highly flexible for that as well. So a lot of our clients tend to be multi-state and infrequent use or new codes coming, going, et cetera. Particularly for staffing companies, we work out quite well that way as well. So it's very easy to get quotation for, whatever pricing model that I use for their initial quote. I apply it to their new codes as they want to grow in another state. I'll just replicate the pricing model that they purchased or they bound on, and apply it to all those new codes and states and so on. So flexibility is what we're after with our clients, make their life a lot easier. For us, it's fairly easy, and that's what we do all day long. So we make life a lot easier for our clients, and helps a lot of retention as well.
Absolutely, I've seen it live. So I know we've ignored you, David Ainsworth, from the benefits point, and I kind of brought up earlier before we got on the call for the Zoom and the podcast was that a lot of agents sort of shy away from the benefit discussion, P&C agents, or just refer it to their benefit team if they have one, because it sort of is a very complicated conversation. However, I want to say that yes, we'll take care of getting the work comp piece and the other areas settled for the agent, which is going to be the primary reason they come to us. But to keep an open mind, because David, you're about to tell us some cool things you're doing on the benefits side that are very unique, and that the good news for people like myself and Ryan, who don't really like benefits either per se, you guys take care of everything. So you kind of want to walk through that?
Yeah, no, that's fine. And I know from being in the industry for a long time that benefits is always a struggle for people. But in addition to the workers' comp piece, so the workers' comp is really what the business owner is looking at, trying to take advantage of some of those pooled risks that they can have through Zynergia. But the benefits piece is kind of structured the same way. So at the end of the day, the benefits package is something that helps retain and attract quality employees. And so we know that the BUCAs are broken. And for all you P&C guys on the call, BUCAs are Blue Cross, United, Cigna, Humana, and Aetna. So that's just an acronym for that. Rates keep going up and benefit levels keep going down. So what we were able to do is we went all the way back to 1947 to find something that the government did right and utilize the Taft-Hartley Act. And so we built ourselves an association plan by utilization of the Taft-Hartley and some collective bargaining within our family of companies, and opened it up to groups that are outside of our family of companies. And Zynergia has access to that through the clients that they're able to bring on. And at the end of the day, we went live July of 22, and we decided to move to a calendar year renewal, and we had a 0% increase January 23. So as 23 progressed, and we had multiple clients from all over the country join our risk pool, and we continued to perform well, we actually had a minus 20% average decrease for our 2024 rates. So what that
never
means,
happens in the real world.
well, so we have some secret sauce. Our TPA that administers the plan is part of our family of companies, and they know how to work with, hospitals and facilities and doctors because they've been doing it since the 80s. So we have a very strong advantage there to get those claims negotiated down. From what they told us, we had 0 balance bills last year, which means that the members who were enjoying coverage did not have to pay anything additional out of pocket than what their plan covered. So that's a bonus for them. We have multiple networks. So we've got the largest private healthcare network in the country. And then we also have access to the Cigna PPO network nationally as well. So, we have a way that we think that groups and employers can get off the hamster wheel of just accepting that 10, 15, 20% increase every year from the 800-pound gorillas because they don't care. So we're actually trying to go backwards. And hence is the name of our program, which is Employers for Cheaper Healthcare. So it's the ECH. And so our goal is to offer richer benefits at a lower cost to companies all over the country.
Hey, David, does every client of ZynergiaHR have access to your benefits, or is that catered just for the PEO clients, or can you elaborate on that?
Yeah, Ryan, it's a great question. So yeah, the way that we're structured, so the agency that my team represents work as consultants for all of Zynergia's clients, whether they be PEO, BSO, staffing, doesn't matter. So, and also too, the access to the ECH does not necessarily depend on the PEO relationship or having a relationship with Zynergia. So we can work it as an individual independent entity that we can write outside the PEO, but certainly everyone that is on ZynergiaHR services has access to the ECH benefit program.
Awesome. Music to my ears.
And then David,
Happy to help.
talk through how you would you could either, if the agent does not have a benefits department or have someone that they trust that wants to deal with this, they could just sort of drop this in your lap and tell them what you'll do to handle everything, soup to nuts.
Yeah, no, that's great, Eric. So my team can be as involved as you need us to be. Knowing that there's some nuance to this, it takes a little bit of understanding of how the program works from behind the scenes to help walk clients through that. We don't expect anybody to have a PhD in this, and so we have very simplified underwriting. It's a census template, and so if we can get the data that's on the census put together, we can usually get a quote back within 48 hours of what the group's going to look like on our program. And then we'll work with you as much as you want us to, so we can be as involved, but it doesn't alleviate the credit that you'll receive for bringing us that client and helping us get them across the finish line. So our team is standing at the ready to partner with you, not to take over, not to take your client away, anything like that. We want to continue to get our message out, and we want to partner with you guys to get as many of your groups that we can help.
That makes sense. And so also, when you do bring the client on, you can handle, go into a little more detail, like you'll handle with the, obviously, we can go over the quote with the agent to make sure, okay, hey, compared to what they have today, this was looking very good. It's a good fit for the client from a network perspective. And then turn it over to David. You can finish off the Q&A. Then let's say they come on, talk about Ben admin and everything that you'll do for that.
So yeah, easy enough. So if the group is part of Zynergia services, it's real simple. I mean, all the benefits administration is handled through their human capital management program, which is iSolved. So, the clients will get their bill, and then they'll whatever the employee deductions are, they're taken out of that. From an actual plan administration services, what's really great about our program, which is different than most insurance carriers in the field, we have a concierge service. So folks have questions about their plan, where to find a doctor, prescription drugs, procedures. There's a concierge service through Quilexa that they can call and actually speak to a human being, a warm body, that will walk them through their benefits and help them with whatever challenges they have. And then, like I said, getting back to the Zynergia piece, through open enrollment, when they'll be able to see their entire benefits, they'll be able to see, what their per pay period deductions are going to be. Everything's done there in the system in iSolved. It makes it very simple. Everyone gets a login. They have opportunity to enroll in additional benefits there too. So there's ancillaries that they have access to: life insurance, disability, critical illness, accident coverage, pet reimbursements. There's all kinds of stuff that's on there that folks will have access to.
And you'll handle like the ACA, the COBRA, the reconciliation of billing versus, people terminating and coming on and off the policy?
Yep, all that stuff goes through reporting. And so when folks come on or they're off board, we have COBRA administration that Colexa handles as well. For onboarding, a client's going to set up their, benefits eligibility rules. And then so when folks come on board, if they're new hires, depending upon when those are, it'll trigger them to log in and to go through the open enrollment there. Everything is done through reporting that happens every week.
And talk about the flexibility. I think you mentioned you have like for contributions and participation requirements because of the way you set this plan up.
Yeah, that's a great question, Eric. So because we understand that sometimes groups that come on to PEOs may or may not be able to contribute toward healthcare just based on the size of their group and what their budget looks like. The ECH, because it's a federal program, it's not part of the state DOIs, has some flexibility there that there's not a minimum employer contribution that's required. In addition to that, there also isn't a minimum employee participation requirement. Most plans, whether it's an outside open market or some PEOs, mandate that you have 50% of the folks enroll in health, or you get surcharged or these other things. We don't have any of those situations. We've just got some flexibility because we want to be able to cater to those businesses that maybe not have been able to offer health insurance because of some of those restrictions. Now, of course, we want to get as many folks on board as we can because what's great about our program is we renew as a pool. So it's not just looking at that individual group, whether they had a shot claim, last year, 6 people are on Ozempic or something like that. We're looking at how we all perform together as a large pool, and then we get renewed the next year. And that's how we were able to get a 0% increase our first year and a negative 20% decrease our second year.
P&C agents, have you run into Byberg, which is a Berkshire Hathaway company quoting workers' comp for either your prospects or clients? Well, great news. Insured Solutions, a national MGA, has an appointment that is set up to allow you to quote, bind, and service Byberg at your agency. And the coverage is in all states. It's A-rated. Startups are even accepted. There's $125,000 maximum premium. And some of the tough industries they write are construction, transportation, that includes towing and parcel delivery, manufacturing, security guards that are armed and unarmed, motor mediation, and many more. So go to our website at insuredsolutions.net, click the Get Appointed link. We'll get you logins for you and your team, and can set up a webinar for training if you'd like. Also, feel free to email info@insuredsolutions.net, and I can handle the submission myself, or call 770-402-5343. Be glad to speak to you and give you more detail. Thanks. Yeah, given some stability.
Wow.
Go ahead, Ryan.
No, I was just going to touch on that. So you guys can do, let's say if there was a 5-man group and 2 of those individuals wanted to be on your program, would that be appropriate, or would you want more than that?
Well, we're not going to decline them. We're going to look at them. We're going to underwrite them and see what their risk looks like. And if it's something that's not going to have a negative impact on our pool, they're certainly eligible to enroll, and we will work with that. We've got some groups that actually only have 1 employee on health. They have, multiple employees eligible, but there's only 1 on health. Now, that may change next year because they're looking at, oh my gosh, this person's paying so much less, and it's something that they can take advantage of. But yeah, we can work with that.
I've had the reason I was asking is I have instances where you've got a small business where they have maybe 5 to 7 employees, and maybe 2 of those employees are the owners who want to be on the plan, and yet the other employees, they don't want to offer it, or just don't, the employees don't want to take it. So, but the owners do want to participate. So that would be an option then with you guys, depending on their underwriting history and everything of that nature.
You might want to. We're talking about ECH, but we do have other options. So he's talking about ECH, but we do for other situations, as with most of our business, we've contemplated all these different scenarios and circumstances. So we actually have a couple of other national plans that can be utilized, but DA can.
Yeah.
describe that?
Absolutely. As with everything that Zynergia does, we've got bifurcated options. So whether it's dental and vision, we've got multiple carriers. Healthcare, we've got multiple carriers. Um, and obviously workers' comp, they've got multiple carriers. So it's good to have choices to try to make sense to what the client needs and not try to just put them into a box. So yeah, we do have other options with national carriers that also have flexible participation requirements, not flexible contribution requirements, but flexible participation.
That makes sense. Like I think we were talking earlier about one of the clients that I just brought on that has a temp staffing arrangement with their commercial electricians that they place, and they are just unable to meet participation requirements. They got a very large, it was like, I don't know, $8 million payroll. So it's a large, temp staffing arrangement, but they can't meet participation. So that was our agent that we worked with on this account was not only excited about the work comp piece to this, but, was definitely, once it got settled, wants to bring you in to talk about the benefits side, just because you just answered a problem he was having, because he does help deal with the benefits side for that client.
Sure. Be happy to talk to him and see what we can do to make a fit for him. Because at the end of the day, we're really just trying to help people out. Benefits is tough, and everybody's on that hamster wheel, and they're just used to their 10, 15, 20% increases, and they're trying to figure out how they're going to budget next year, and they got to raise their costs, and they've got to figure out how to give people raises and promotions and things like that. So being able to rely a little bit more on how much your spend is going to be on your benefit structure for your employees is a better way to let them run their business. So we're all about finding solutions for them.
No, it totally makes sense. And then also, depending on the type of plan, most of the things you offer, you are able to pay a commission on, which is another, a positive word to the agent that they can earn a commission and really not have to be involved with enrollment, ben admin discussions on it if they don't want to be.
Sure. Yeah. So the way that we're structured is the agency that my team represents, we pay what's called a marketing referral. So it's commensurate with what they would get from one of the BUCAs if they were selling the health insurance through them. But our health benefit uses a marketing referral, and we set up those agreements with them directly.
No, it makes sense. Makes total sense. And also, as you said, I think earlier, maybe David Bell, that because they're the networks that you can place these in, this is really good, a really nice benefits or feature for or program for national or multi-state companies.
Yep. And we've got multiple clients that have employees in multi-states, and plus, with the remote environment that folks find themselves in for some of the white collar businesses. The great thing about it too is regardless of the group size, we get them a composite rate. And the plan designs are, everything that you would see from the ACA. We've got, bronze, silver, gold, platinum, and a high deductible plan. And then we also have a couple of additional plans that we kind of created on our own, but they're still above MET compliance. So they're still MVP level, and they're steel and copper. But they're a little bit more high deductible, high max out of pocket, but they do include prescription drug coverage and things like that. So we have multiple options. And again, folks in one state versus another state can take advantage of the same plan level, same network, same premium.
And I haven't seen it in a while. You do already have, a set pricing grid if they make the cut in terms of underwriting, or is it price based on the group typically?
So we have kind of thresholds this year that we've established. So there is a kind of a baseline rate, which is basically risk score based on what our total pool was at the end of the year of 23. So our 2024 rates are based on how we performed as a pool. And then as the pool gets larger, when groups come in, we do underwrite them to find out how close they are to that risk threshold of being even. And then based on if they're plus or minus, if they're plus, then we could potentially have a rate up of a few percentage points, which would be their rate for the rest of the year 2024. But then at 2025, we would all renew together. So there is a risk score that's allocated to find out what that intro premium is.
Okay, so depending on when they come on to the program, they would only get you'll notify them of when their particular renewal would actually be. It wouldn't be a 12-month.
Right. So we're going to renew 1/1 as a pool. So everybody as a pool. So that's a good question. So, it could behoove someone to come in, and even if they have a slightly higher risk score and get a little bit of a surcharge, they actually could get a tremendous discount in 2025 by being part of the larger pool instead of just their individual group.
Okay. I guess it could go the other way too, just not to be
Yeah.
negative, but
Well, so far so good. We've got
Oh,
really
yeah,
good
'cause you've
people
got
that
like
are
reductions so
administering it and
far. Yeah,
mitigating our risk. They're really good at it.
that's right. That's right. You've got reductions actually. And then are you able to pass then some of those reductions on in rate pricing then to the pool, or do
So,
you try to keep it to buffer the plan?
so the plan itself is based out of a self-funded trust, and there's a loss fund that's part of that that's been allocated as part of all the premiums. So all the premiums kind of go into one area, and then there's different pieces that are segregated out based on that. Any surplus that we have in the trust at the end of the year, particularly considering the loss fund, is reinvested back into the following year. So that's how we're able to lower rates for everybody. So it's not going to be based on a client by client. It's going to be based on a collective, kind of the way insurance is supposed to work. The law of large numbers. So we're trying to do it that way.
No, I think when they started the Obama ACA plan, I think they were trying to talk about it that way. It obviously didn't turn out, but you guys are figuring it out, to make it work as far as that goes. And also, I think talk about that prescription plan. I remember talking to you and Eldridge, I think, about how phenomenal it is, to the kind of coverages you're getting on that, where it's like almost zero out of pocket on most of the drugs, for the employee.
Yeah. So having folks that have been in the benefits insurance industry for multiple decades, we know that the major cost of most insurance plans is going to be your prescription drug spend. So because of our sister companies and some of our affiliations with some hospital networks, we're able to take advantage of some 340B, which is basically Medicare cost for drugs and some government discounts. We also have mail order that's available to us, which also cuts down on costs. So for folks that have maintenance drugs and things along those lines, they can mostly get those mail order generics for free. So what we're really trying to do is impact it on the member side, make their life a little easier, make their out-of-pocket costs lower. Again, there's a couple of different things that you can't just necessarily go down to CVS and pick up whatever your doctor just prescribed you, unless it's an antibiotic or something like that. That's different. But if you've got a maintenance med, it's going to behoove the member, and it's just an education piece to say, hey, look, here's your information. They send out letters too when they enroll to explain to them all of their prescription drugs. But it gives them an opportunity to take advantage of some programs that are going to give them a discount, our plan a discount, which helps everybody.
No, totally makes sense. Anything else you could think of that might be unique about the plan, or a selling point with for the PNC agent and their client?
Not just to reiterate that it kind of, like I said, it gets them off of the hamster wheel, it gets them off of that 10, 15, 20% standard BUCA increase. Uses the similar networks that those BUCAs are built off of. So in other words, the folks don't necessarily have to worry about trying to find a different doctor. If they have trouble with a doctor, let us know. We'll help contract with the doctor. So those are things that we can do. As with David in the workers' comp program, we're very flexible. So, our goal is to move with our clients and not just to try to put them in a box and say, this is what you get, good luck. And again, our concierge service, which is also in synonymous with the PEO and their white glove service, we really want to treat people with respect and dignity, and just change the model a little bit, just try to make it better.
And the great thing is you mentioned like similar to the flexibility of the payrolling scenario based on timing with the client, you're able to write this benefits package without the PEO if necessary. Because maybe it's not a fit, the PEO model is just not a fit for the client right away. Then again, like I mentioned earlier, so that we don't complicate things, I like bringing you in like right when the client gets settled, if the agent wants, but right when the clients get settled in, with the
Sure.
workers' comp and the payroll model and such, or the reporting model, they get settled in. I bring you in as the extra, service model that in addition to what Zynergia is going to do on the HR and the risk to sort of tie in that white golden handcuff with that client to help keep them retained and happy,
Yeah.
because the more products and services we can get them engaged in as part of Zynergia, the longer they're going to stay. Their overall business is going to improve, because what I've noticed is that when they have this helping hand really come in to put together the benefits to take care of the employees, you don't see as many, weekend work comp claims happening, because they've got insurance now. They don't need to come in and, break a leg or sprain a knee or whatever from softball from the Sunday before. So, and then on the risk side, you're getting back to work as quickly as possible. Clients getting the claim service because they're not having to fight that battle by themselves, as we talked about earlier on the workers' comp piece. So it all does kind of come together as a nice package, when the client engages with not just the workers' comp.
Agreed.
Well, David, I appreciate your time and enjoy the partnership we have with you. For agents, I'll just kind of set the stage. If you haven't been working with us as of yet, on this type of program, we again can just utilize the Accord, the 3-year loss history currently valued, 60 days, I believe, for your program. Any kind of supplemental mod worksheet that you have to help, describe the client's operations, helps David in his pricing, David Bell with his pricing as well. If you already know that they need benefits, that just a regular census could start that conversation, and then Ainsworth could get in touch about that if we want to address that along with the workers' comp. That's totally fine. If we want to separate it, not a problem there. But you just email that submission to us at info@insuredsolutions.net. My phone number, if you want to discuss an account prior to this, is 770-402-5343. And again, most agents we work with are submitting within at least a month or more of the renewal date. So I recommend we go ahead, get an indication from Zynergia, see if it's a fit from a price perspective, in general, or if you already know they want the PEO, let's just go ahead and get it, of course. But and then give about 3 to 4 weeks if we can, if that number looks okay, to go ahead and have that call with the client, get them comfortable with the payroll conversation. The agent will be able to answer the work comp questions, but we need Zynergia's team on to answer the payrolling questions. And if there's benefit questions, if David needs to be involved, to just talk through, hey, once you come on, here's what you can have. We don't even need to get into a proposal there, although David could show the agent some of his plan designs and just let them see generically what's available, which is very impressive, to be honest, and which I recommend that. But anyway, 3 to 4 weeks ahead if we can. And don't worry, agent, if you get a better price or better thing, or the client decides against the PEO this year, no one's feelings is going to get hurt. Not us, not David and David, because we all get it. It's a numbers game for us and too. But at least, you as an agent, I think you're showing an incredible due diligence. It was really appreciated, I know, when one agent I recently did this with, we presented 3 weeks early, and the client was just more comfortable. Now, they ended up not going with a PEO in that particular instance, but we were able to help the agent on another just standard workers' comp program. And now we've got that relationship with the agent and the client. So now next year, and the client now has heard of Zynergia, we want to maybe try again the following year once we can bring up the benefit conversation next time. So long story short, it's not a waste. And it shows good due diligence, I think, on the agent side, gives that client time to digest it. And if it's not a fit, no worries, we'll just talk about it next year. But it's just a good thing. However, if we don't have that kind of time, or if as an agent, you don't want to present this program the way we discussed as far as with payroll, that is where David and David can still come in and do what they do with a reporting type format. And David Ainsworth on the benefits side, not tying it into payroll this first part of the year or first year is not a problem. He could still, do the program. So that's that flexibility. So we've got both, just with payroll helps the client consolidate more. Any guys you want to add to that, David or David?
No, that's a good summary. Lots of flexibility and lots of different ways to fit the client needs. So I think in most circumstances, we're at least a good sounding board, market litmus paper for comp, maybe for benefits, for, you know, on the benefits side for price, but also for access and so on the comp and HR services side, same thing, litmus test and pricing. You know, try us out and it's no harm.
Right.
Absolutely. Yeah, we have a high retention with you guys. So, you know, we're speaking from experience in the past about 4 years we've been working together. So looking forward to a lot more.
No, yeah. On our side as well. Yeah.
Yeah, we appreciate the
Going
partnership.
real,
Yeah,
very well.
same here.
Yeah.
We appreciate you guys and very much. And thanks what you're doing for, you know, helping to improve the view to agents of the PEO industry with this flexibility. I think everyone's seeing in this conversation. You know, it really means a lot to show that to an agent because they're not used to seeing it with a PEO. It's kind of do it our way or get out, you know, to get this type of program. And the PEO is not being nasty. It's just they're not set up for the flexibility the way you are, you know?
Yeah, and explanations, conversations, all open for all of that. And like I say, we never try to start with a box because we're interested in helping agents and clients, and there's lots of things that we can do. So those conversations are educational. If they're not completely aware of everything, if they have a lot of experience with PEOs, it's also a good conversation because they can pick and choose their best that they've experienced in the past, and we're probably able to replicate that for them as well. So, you know, so it's usually beneficial one way or another to have a conversation with, you know, Insured Solutions or us. So either way.
And we'll set that up anytime.
Yeah.
We like bringing you guys in. Really, all our partners we have, we are totally open to bringing them in, but especially you guys, because you do such a nice white glove piece to it. We're confident that, you know, it's going to go well, and whether the client goes forward or not, or the agent wants it to go forward, that's another story. But you guys do your part of just getting out and parlaying the info so that the agent and the client just are more aware. So again, thanks again, guys. I appreciate the time, and you know, we're going to talk soon, you know, about all this.
Okay, great.
Thanks, Eric. Appreciate you.
Appreciate it. Yeah, thank you.
Thanks again for tuning in to Insurance Shop Talk. If you enjoyed our deep dive into the latest trends, please don't forget to like, subscribe, and hit the notification bell so you never miss an episode. Until next time, I'm Eric Stein, and this has been Insurance Shop Talk.